745 7th Avenue in Midtown Manhattan was the address of Lehman Brothers Holdings Incorporated from 2001 till September 15, 2008, the date on which the firm filed for Chapter 11 bankruptcy protection in the largest corporate bankruptcy in American history. The building was a 47-floor glass tower that Lehman had developed and occupied as its global headquarters, a physical statement of institutional permanence in the most competitive real estate market in the world. On the morning of September 15, 2008, employees arrived at 745 7th Avenue carrying cardboard boxes. By the end of the week, the building's identity as the center of one of Wall Street's most powerful investment banks had been dissolved by a weekend of negotiations that produced no rescue, no buyer, and no alternative to the filing that the firm's liquidity position had made inevitable. The forensic entry point for this case is not the bankruptcy itself, which has been documented in more detail than any corporate failure in American financial history. The forensic entry point is the building, because the building at 745 7th Avenue documents something about the Lehman collapse that the financial analysis alone cannot capture: the relationship between physical infrastructure and institutional certainty, and the specific speed at which that certainty can dissolve when the financial architecture beneath it fails. Lehman Brothers had occupied various addresses in Midtown Manhattan for more than a century before developing 745 7th Avenue as its permanent global headquarters. The decision to develop a dedicated headquarters tower rather than lease space reflected the firm's confidence in its institutional permanence at the peak of its expansion in the early 2000s. That confidence was not irrational at the time it was expressed. Lehman was one of the 5 largest investment banks in the United States, a survivor of multiple financial crises across its 158-year history, and a firm whose fixed income and real estate businesses had generated returns that its management had characterized as the product of superior risk management rather than of the leverage that, in retrospect, the returns required. The 47-floor headquarters that expressed that confidence was fully occupied on Friday, September 12, 2008. It was the subject of employee evacuation planning by Sunday, September 14. The cardboard boxes arrived on Monday morning. The forensic record of what happened to the building between those 3 days is the record of what happened to the institution, expressed in stone and glass rather than in trading positions and balance sheet entries. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. Lehman Brothers' real estate exposure at the time of its bankruptcy filing was not limited to its headquarters building. The firm had assembled, through its real estate principal investment activities, a portfolio of commercial real estate assets valued on its balance sheet at approximately $32 billion, a figure that independent analysts had been characterizing as materially overstated relative to the market values that the commercial real estate sector's deterioration had produced in the 18 months preceding the filing. That overstatement was not a clerical error. It was a valuation methodology that Lehman's management had defended publicly and internally against external challenges that the firm's creditors and counterparties had been raising with increasing specificity throughout 2008. The specific real estate positions that contributed most directly to Lehman's liquidity crisis included a portfolio of commercial real estate loans and equity positions assembled during the peak of the mid-2000s real estate expansion cycle, at valuations calibrated to market conditions that had ceased to exist by the time the positions appeared in the firm's quarterly reports. The same appraisal error that this channel has documented in the hospitality sector across 20 case files, the treatment of peak cycle valuations as stable baselines for leverage decisions, was present in Lehman's commercial real estate book at a scale that the hospitality sector's individual property failures had not approached. The covenant structure governing Lehman's real estate positions was not written into any individual loan document, It was written into the firm's overall leverage ratio and its counterparty relationships, which required Lehman to maintain liquidity buffers adequate to meet margin calls and collateral demands from trading counterparties whose confidence in Lehman's solvency was itself a function of their assessment of the real estate valuations that Lehman was reporting. When those counterparties began questioning the valuations, they reduced their willingness to extend the short-term funding that Lehman's balance sheet required to maintain its leverage positions. When the short-term funding withdrew, the leverage positions became unsaleable at prices that would have preserved the firm's solvency. The building at 745 7th Avenue was the collateral expression of a leverage structure that had no mechanism for surviving the simultaneous withdrawal of counterparty confidence across multiple asset classes. At what point does a firm's public defense of its own asset valuations become an act of institutional self-deception rather than legitimate disagreement with external critics? Leave your analysis in the comments below. The appraisal methodology that Lehman Brothers applied to its commercial real estate portfolio in the years preceding its bankruptcy shared the three-input failure pattern documented across this channel's archive, but expressed it through the specific mechanisms of investment bank balance sheet accounting rather than through the hospitality asset appraisal reports that previous case files have examined. The stabilized value projections for Lehman's real estate positions assumed a commercial real estate market trajectory that the housing market's collapse had already begun to invalidate before those projections were finalized. The capitalization rates embedded in the valuations reflected the compressed yield environment of 2006 and 2007 rather than the expanding yield environment that investor risk aversion was producing in 2008, and the liquidity assumptions embedded in the portfolio's carrying value treated positions that had become effectively unsaleable in a distressed market, as if their book values were realizable through orderly disposition. Lehman's management was not alone in applying this methodology. The same valuation framework was being used by every major financial institution carrying commercial real estate exposure in 2008, and the regulatory framework governing investment bank capital adequacy had not required those institutions to mark their real estate positions to the distressed market values that independent observers were identifying as more accurate reflections of what the assets could realize in a forced sale. The appraisal failure at Lehman was therefore a systemic failure of the valuation methodology applied across the financial sector, expressed most catastrophically at Lehman because Lehman's leverage ratio magnified the impact of any valuation correction beyond the firm's capacity to absorb it. The specific commercial real estate positions that crystallized Lehman's losses most severely included its investment in Arcom Real Estate Fund Manager, its equity positions in commercial real estate development projects in the United States and Europe, and its exposure to residential mortgage-backed securities whose underlying collateral had experienced the valuation corrections that the firm's own analysts had identified as likely before the broader market had priced them. The gap between what Lehman was reporting as the value of those positions and what independent analysts were identifying as their realizable value was the same gap that every failed asset in this channel's archive has produced. The gap between what the ownership needed the asset to be worth and what the market was willing to pay. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The weekend of September 13th and 14th, 2008 produced one of the most precisely documented negotiating failures in the history of American finance, a 48-hour period during which the United States Treasury, the Federal Reserve Bank of New York, and the chief executives of the major American financial institutions attempted to construct a private sector rescue of Lehman Brothers and failed to produce one. The failure was not caused by the absence of willing participants or by insufficient government engagement. It was caused by the specific characteristic of Lehman's real estate portfolio that distinguished it from Bear Stearns, whose rescue by J.P. Morgan Chase 6 months earlier had been facilitated by a Federal Reserve guarantee of Bear's most troubled asset pool. Lehman's real estate losses were large enough, uncertain enough in their magnitude, and sufficiently concentrated in positions that potential acquirers could not value with confidence, that no private sector buyer could construct an offer that the losses would not immediately render insolvent. Barclays, the British bank that had been the most serious potential acquirer, withdrew from the negotiation when it became clear that the British financial regulator would not approve a transaction of that scale and risk on the timeline that the weekend imposed. Bank of America, the other serious potential acquirer, chose instead to acquire Merrill Lynch, a transaction that its own management had concluded carried less uncertain real estate exposure than Lehman. The Federal Reserve declined to extend the guarantee that had made the Bear Stearns rescue possible, a decision whose rationale has been debated extensively in the years since, but whose consequence was the bankruptcy filing that the Monday morning cardboard boxes announced. The building at 745 7th Avenue was subsequently acquired by Barclays, which assumed Lehman's North American operations and needed the headquarters infrastructure to house the employees it was retaining from the failed firm. The transaction was completed within days of the bankruptcy filing, at a price that reflected the distressed circumstances of the sale rather than the market value that the headquarters development had established. The building that had expressed Lehman's institutional permanence became, within the week of its bankruptcy, the headquarters of the British bank that had declined to rescue it. The Barclays acquisition of 745 7th Avenue and Lehman's North American operations produced an outcome that no previous case file in this channel's archive has documented: a headquarters building that changed ownership, flag, and institutional identity within the same week as its original occupant's bankruptcy, without ever experiencing a period of vacancy or commercial inertia. The physical infrastructure of Lehman Brothers became the physical infrastructure of Barclays Capital within days. The employees who had arrived with cardboard boxes on Monday were working for a different institution by Friday, and the 47 floors that had expressed Lehman's certainty were expressing Barclays' ambition before the bankruptcy court had processed the filing. That outcome distinguishes the Lehman headquarters from every other asset in this channel's archive. The Fontainebleau Las Vegas stood vacant for 15 years. The Revel Casino stood vacant for a decade. The Drake Hotel declined for 40 years. The Waldorf Astoria has been closed for 9 years. The Lehman Brothers headquarters experienced zero vacancy. The institution that occupied it failed in a weekend. The building recovered in a week. The forensic question that the Lehman case poses for the first time in this channel's archive is whether the building's rapid recovery reflects genuine asset quality, the headquarters of a major financial institution in Midtown Manhattan being inherently valuable to a successor institution, or whether it reflects the specific accident of a bankruptcy whose resolution happened to produce an immediate buyer for the physical infrastructure at a moment when other assets in this channel's archive waited years for equivalent resolution. What the Lehman Brothers headquarters case reveals in the context of this channel's 21 case archive is the specific relationship between institutional identity and physical infrastructure in the financial services sector. Every previous case file has documented an institution whose physical infrastructure outlasted the institutional identity that had created it. The Lehman case documents the reverse: a physical infrastructure that was fully absorbed by a successor institution before the institutional identity of its original occupant had been legally extinguished by the bankruptcy proceeding. The 47 floors survived the weekend. The institution did not. The building never had the opportunity to become a ruin. It was too useful for that. If this case file changed how you evaluate the relationship between institutional identity and physical infrastructure in corporate headquarters real estate, subscribe to this channel, because the next case examines a building whose institutional identity outlasted its owner by 40 years and whose survival raised questions that the real estate market has never adequately answered. And in the comments, given the Federal Reserve's decision not to extend the guarantee that had made the Bear Stearns rescue possible, what specific regulatory mechanism would have changed the outcome of the Lehman weekend negotiations? The case file is open.